Are you ready to take your business to the next level? Every day there are countless books and articles that are published offering the key on how to make your business a success. It's easy to feel overwhelmed trying to keep up and run your business. That's why Deb Creer created the Business Power Hour. Keep up on the latest trends, best practices, and techniques for how to make your business a success. Let the Business Power Hour do the heavy work for you.
Good morning. Good morning. I am Deb Creer, and I am passionate about giving professionals the tools that they need to make themselves and their businesses as successful as possible. And today, we're going to talk about the thing that so many people kind of overlook, but you absolutely positively need this in order to be successful. And that's managing your money, making sure you know what's going on. And in many cases, actually having a financial officer or person who is helping you out. So please join me in welcoming Jim Downs to our program today. Welcome, Jim.
Good morning, Deb, and thank you for having me on your program. I'm really excited to be here.
Great. All the way from sunny California. I shared with you that we were expecting snow, so I'm very jealous. Let me tell people a little bit about you, and then we'll dive into this. So Jim Downs is a Fractional Chief Financial Officer and forward-looking strategist. He is the founder of Blueprint CFO, a future-focused CFO and accounting services firm based in Orange County, California. By holding clients accountable to their growth goals, Jim and his team provide a competitive advantage over typical CFOs by leveraging data to create a profitability roadmap for success. So again, Jim, welcome to the program.
Thank you. I'm looking forward to it.
Well, I always like to have my clients tell us, or my guests, tell us about how it is that they got to where they are today. So you've always been kind of that financial geek looking through your profile on LinkedIn, but tell us how it is that you got to where you are and how you discovered that this really is your passion in life.
So I started my career in Detroit, Michigan, a long time ago as a CPA. Okay. And I was a CPA with a CPA firm for 11 years or so, working with a number of different companies. Primarily, though, as a CPA, I was doing tax returns for them and tax planning and also reviewing their financial statements at the end of the year and telling the bank whether they were correct or not. And one year, one of my clients said, "Okay, Jim, you've been our financial CPA for years. What do you think we should do different next year?" And I didn't really know because I really didn't know much about their company. Because when you're a CPA, you're really just looking at the year-end results and identifying if they were correct and putting your name on it that says you've looked at this and it looks right. But you really don't get into the details of how, who the customers are and what the products are and how much you price the products for and what kind of margins the products or services generate. But you don't get into how the people are being compensated. So there's all these things that are going on in a business that a CPA just doesn't have time to get into. So I decided that I was going to stop being a CPA and become a consultant. And I started my Fractional Cfo practice in Michigan in 1990, roughly. And so that started me down the path of working with business owners to help them look at their financial data and make sense of it, number one, and then think about how, whatever the result is today, how could we make that result better in the future? And so that's really the what we call the Blueprint CFO. We're looking at the data and answering the question, what should we do different next year, Jim, that my client asked me that I didn't know how to answer. But it all comes from the numbers because there's a lot of data that's sitting there that the owners or entrepreneurs typically can't get their arms around because they're not trained accountants like we are. And we're able to take that data and make it into a trend line or a chart or a graph that shows them, something really specific that's going on in their business that they need to attend to.
Right. And so many times I think as business owners, we get so caught up in just the day-to-day running of our businesses that we don't even think about planning for the future. I mean, we know, okay, we have to have marketing goals. and and things like that. But we really don't think about from a financial perspective how we get from A to B to C. So kind of talk to us a little bit about that.
So yes, you're very right on. Let's say a couple different things. One is quite commonly, and I just got off the phone with a client who I think is going to sign up with us this morning, and he's grown his company up to a certain point. They'll probably do around 7 million in sales this year or something like that. But he said when they started, his wife took on the role of the bookkeeper, even though she had no accounting training.
Right, but she could
and
add.
She's been doing the books. Yeah, she's been doing the books, for most of the years. And then recently they just hired a bookkeeper, and she's doing whatever she's doing. But when you start out, you don't have a lot of money. So obviously, if you can do your accounting yourself, I guess that's okay. But there's even data in a small company that can be data mined and identified, in terms of what's going on in the business that you don't really realize because you're not looking at the data. So it's very important to, another aspect of that is, typically the client is getting a financial statement every month, which is a balance sheet and an income statement. And so the balance sheet is basically saying what's the stability of the company? Does it have a lot of assets compared to its liabilities? And the income statement is saying, did you make money in that period that you're looking at? If the books aren't being done correctly, then it's all a bunch of garbage. And so number one, you're not a trained accountant and you're not used to reading a balance sheet or income statement. You have no idea what that even means because you're not an accountant.
Right.
And then secondly, if it's not being done correctly, which is if you're doing it yourself, it probably isn't. It's just a bunch of numbers that don't make any sense.
Right.
So now, I equate it to, you're getting ready to go on an airplane trip, right? And you get on the plane, and the pilot comes along and says to you, hey, we have a little problem. All of our instrumentation went out, and we don't really have any instruments, but we're still going to fly from here to Atlanta. Would you stay on that plane? Probably not.
Probably not.
This guy's But most business owners run their business without getting data that makes any sense. They just do everything based on their gut instinct and rely heavily on how much cash they have in the bank, which could be totally misleading.
Right.
There's many companies that bill ahead on projects and get cash up front. And so if you have a lot of cash in your bank account, you may owe that money back to the customer until you deliver a product or service. So, just looking at your cash balance isn't really the true barometer of whether your company's making money or not.
Right. Yeah, I remember a cartoon. I was a little girl, and my grandma had this. She had a book of cartoons, and she had this one that my mother took and put on my dorm room wall. I remember this, and it said, "But I can't possibly be overdrawn. I still have checks." And I think that's the way we don't understand the concept, right? Well, I still have a lot of people don't even know what checks are nowadays, but that's the concept is I have money in the bank, so I must be okay. But it's that whole, do I even have money in the bank type of thing? It might be there, but is it really there? Like you said, it might be owed to other things. You might have, commitments.
You may have money in the bank, but there could be checks you wrote that haven't cleared the bank yet. That when they clear, you won't have any money in the bank.
Right. And obviously things like salary and taxes and all of those things.
Exactly.
And it's, we just don't know how to read those numbers.
So we practice what we call future-based accounting, which is, I just wrote a chapter of a book about this. And it's, because most accountants are really historians. They're documenting how the company did in, right now we're in January. How did you do in December? And they stop right there. Here's your financial statement. I'll see you next month when I do the January financial statement. But the starting point is, how did we do in December? But how can we do better in January and February? That's what we do.
Right.
It's taking those numbers and saying that's the benchmark of performance, but how can we make that better? And I think that's a unique thing that most accountants don't do. They're in a big hurry, like I was as a CPA, just to get the numbers done and document the historical periods without really thinking about the future in terms of what could be different.
Right. Well, and the CPA is really just given the line items. They don't know what goes into everything. For salaries would be a good example. They might know that they might not even know how many employees you've got, but maybe they know, okay, you've got 5, but they have no idea, based on industry, is that good? Are you paying commission? All of those things. They just see that number.
Exactly. And they don't, by the way, they don't know what those people do.
Right. Oh yeah. They just know, hey, you've got 5 people.
Do you really, normally it's not 5 people, it's like say 50. Well, do you need all those 50 people? What does each person contribute to the profitability of the company? That's an important thing to think about. And, the number one area that we focus on in looking at what we call key performance indicators that clients should be paying attention to is labor productivity. Because you have all these people coming to work every day, and how much revenue are you generating per labor hour? And that should be going up over time. You should be generating more revenue per labor hour if you're becoming more efficient.
Right.
But if you're generating less revenue per labor hour, that means you're losing efficiency, because you used to be able to create more revenue per labor hour in the past. So you need to be looking at what people are doing, because you're wasting money somewhere.
Right. And I think probably a lot of this is why about 2 years ago, a lot of people looked at their books and went, oh, crud, because that was when COVID hit. And, and I still laugh over the fact that everybody said, oh, it'll be 2 weeks. And, it wasn't really anybody that thought this is going to take 2 weeks.
We all hoped it was 2 weeks. It jumped in 2 years.
Yeah. But I think, it really was that wake up call to so many businesses as to whether they could survive. I mean, some of them couldn't even make it those 2 weeks. But then when it was 2 months, when it was 1 year, when it's, we're just about to go past the 2-year point, and that was where I think so many people realized they did not know what the heck they were doing from a financial perspective.
100%. I mean, you just said you're saying what I would say. So it all comes back to having a plan, and that's the blueprint. Having a plan. I've worked with hundreds of companies, and they're not big companies. They're 5 million, 10 million, sometimes 1 million in sales. But universally, they didn't have a plan. They came to work every day. They might have some kind of budget, which, that's a whole different topic, but a budget isn't really getting you where you need to go in terms of planning.
Right.
Because a plan should include, we're going to launch these new products, or we're going to do less of this kind of work and more of this kind of work. And we're going to get, we're going to become more efficient because we bought this new machine. That needs to be incorporated into your plan, so you can identify into your budget, so you can identify whether your plan is working or not. Years ago, I took a course, and it was called strategic budgeting. And I learned so much about that, because it said, you can't do a budget unless you have a strategic plan documented.
Right.
Because how else do you know how to budget? But most people do their budget based on what they spent last year, which is totally crazy.
Yeah,
because
I spent $100 on this. I'll spend $120 this year.
Yeah. I have a client right now. They spend on average $70,000 a month on sales and marketing, and their sales went up last year $400,000 for the whole year.
Ooh.
So they're spent $70,000 times 12 months is $800,000 to get $400,000 of new business. But at the end of the day, they're making money. If you look at the bottom line, they're making money. So they think it's fine. But when I look at it, I go, that is crazy, But the reason it got there, because over time they just kept adding more money to the sales and marketing and more money to their support team, and it isn't being based on any real strategy. It's just being based on what they spent last year, and they just spend the same amount.
Well, and a lot of times they think we're going to add another person. That'll solve the problem. We'll just add another person.
Yeah, they do that. That's what they say. Well, our sales we project this client actually was doing this. They were projecting their sales were going to go up 15% next year, let's say. which is another 500,000. So they're saying we're going to hire one more salesperson and one more. But I think you need to look at the efficiency of the current team and say, how can we do more with less people? Because if you look at it, we do a benchmark analysis. You can get we're subscribed to a system where people apply for loans at banks and they submit their financial data, and it's all organized by SIC code, which I don't remember what SIC means, but it's standard industry category.
Category. So, I think the C was category, but
category, yes. So we can do an analysis of your company. Let's say it's a company that is a manufacturing company of some sort. We can do a benchmark to compare whether your company performs like the average company in your industry, SIC code. And it goes back 1 year, 2 years, 3 years. So you can actually look at, last year, because of COVID.
Right. Yeah. COVID just, we're all going to have little asterisks, right?
Most people throw 2020 out as a year that we can't use as for any kind of planning because COVID, just made it all different. But, it's important to understand that, because you might find that the average company in your SIC code spends about 20% of their budget on sales and marketing, and you're spending 30. Or, you may find that the average company gets a 40% margin on their product and you're getting 30. So you're doing something wrong because you're not even getting what the average is. You want to be above average.
Right.
Yes.
And that's where you need to sit down and figure out why, and I think that it is hard to do that. And it's very hard to do it when you're in the trenches. Like we said, you don't see those bigger numbers. I mean, you're thinking, okay, I'm going to add another employee. His salary is going to be $100,000 a year. And we think he's going to bring us 200. But there's a lot of other things that go with that also. And I think that's sometimes where people forget is, okay, well, now we've got additional workers' comp, we've got additional supplies, whatever it is that you've got for that person. And so your expenses for him might wipe out that money that he's supposed to be bringing in, or she.
Yeah, right. That's a good point. Most people think of the salary as the cost, but there's all these other ancillary costs: healthcare, 401k, workers' comp, payroll taxes. It goes on and on. So you may find it's the base plus 20% or something like that. Each company's different, especially in California, because our taxes are through the roof here. You really need to be on top of that because it's person is expensive.
Then we're going to add in a little fluke that I think is it's not a fluke any longer. I think it's ongoing. I interviewed someone several months ago who is an employment attorney, and she was talking about the fact that now that we have people who are working in other states and even other countries, that makes things very complicated because you have to be paying taxes for those people in those states. And all of these various things, maybe they're in another country. So, what goes into that? And yeah, I mean, all those expenses really start adding up pretty quickly. And if you're not on top of it, you're in the hole.
Right. You're singing from my songbook, Deb.
I knew it. Yeah, we're buds.
One of our little taglines is if you don't know your numbers, how do you know your company?
Right.
So how do you run your company if you don't know the numbers? And what you're talking about are the numbers. All these things that we're talking about are examples of, those are things that the owner needs to know in order to make an informed decision. But that's where a strong accounting department or a CFO can be instrumental, because now you know the data, you have the data to make a sound business decision if you're going to hire somebody or if you're going to add a certain product line. Or I had a client a few years ago, and they were a plastics company. Do you mind me telling a story, Deb? A little story.
Go ahead.
They're a plastics company, and the owner had invested in a machine that would take old carpet and melt it down and make it back into nylon pellets. And he invested about $1.5 million, and set this machine up in a factory in California here and was running it. And so I went out I was hired to help him be his CFO. And the company was making money, but he had never taken the costs of that operation of doing that recycling and separate it out from the rest of his company to see whether it was profitable or not. And when I did an analysis and I took out the electrical costs and the overhead and the investment they had to make in dust collector, all kinds of stuff, I found that on average he was losing about $1,000 a day running that machine.
Oh,
and when I brought him his numbers, he goes, James, what? He called me James. James, this can't be. And I'm like, well, I said his name was Oren. Oren, when you bought this machine, did you do any kind of analysis before?
And he said, no, I just thought it would be cool.
Yeah, he said, I saw some guy was doing it. I thought it was a great idea. And I know there's like a lot of extra carpet in California, so I decided to do it. And he never really had a business plan.
Right.
It's just crazy. And so within a couple of months, we tried to figure out ways to generate more revenue or be more efficient with the labor, but we just never got to the point where it could make money. So he shut it down. So he wasted $1 million of investment, basically.
Right. Right. Now, what is a fractional CFO?
Good question. So, I'm biased, right? But I believe every company, whether you're a startup or a small company, we work with a lot of small companies, which you would think, why do they need a CFO? But if you need somebody to help you manage your numbers, and it goes beyond what a bookkeeper can do. A bookkeeper is great; they're going to pay your bills and pay your payroll and send out your invoices, but they're really not a business expert,
right?
In most cases, there could be exceptions to that. So we're really a consulting. We're a consultant. We're consulting with companies because we've worked with a lot of companies. In our experience, and we've been there and done that, but we also are working currently with, say, 30 or 40 companies that within Blueprint. So we know all the things that people are doing to save money, not pay as much in taxes, get tax credits, get PPP loans. And so we bring all of that expertise to the business owner at a fraction of the cost of what it would cost to hire a full-time person. So typically on average, we might be working 10 to 20 hours a month with a client because they don't really need a full-time person, but they could use that.
They need the fraction of a person.
Yeah, so they get a fraction of a person. And so in a lot of ways, the cost is offset by the savings that we generate through being smarter about how we do business. That's our goal is to pay for ourselves. We've had clients say to us, well, I can't really afford a CFO, but in a lot of ways you can't afford not to have a CFO because you have all this stuff going on in your business that you're not paying attention to.
Right.
And because you're not getting the data in a format that you can take action from it. It would take you time to go in and do all the analysis we do, and maybe you don't even know what to analyze. But because we've worked with so many different companies, we know where to go, where the money could be being wasted, and we help bring that money to the table. I had that call I had this morning with the fellow that's going to sign up with us. He did ask me at the meeting. He said, "Hey, I don't really know what a CFO does. Can you explain how you're going to help me?" But he's ready to sign up. Yeah, it was a very good question because a lot of times clients actually hire us and they don't know, but they're kind of giving us a tryout. But it's all about making there's data that is sitting there being unused that needs to be used. And our goal is to do this for as many companies as we can, because we know that if we can help American business owners be more efficient, that's good for the country.
Right.
It makes us competitive. Where right now there's just all this inefficiency and waste because people are running their business, based on their gut instinct and not using any data. It's kind of crazy. And there's nobody to help them. The CPA can't help them. Their banker's not going to help them. Their lawyer's not going to help them. Their insurance person. Who's going to help these people?
Right.
Run their business with data. And the data. Somebody once told me, numbers don't lie. The numbers are the numbers. So if you think, hey, I'm really doing great, but at the end of the day, you're not making any money, then you need to have somebody help you with that, and that's what we do.
Well, I always tell people it's it's tricky when especially when you're starting out in business, because we somehow think we have to do it all, and if we don't, there's something wrong with us. Well, that's poppycock, because nobody knows it all. And so I tell people it's like managing your health. You have the general practitioner, you've got a specialist here, a specialist there, a specialist there. And, you rely on them to have that knowledge. Yeah, we do go to Dr. Google a lot, but we still know, hopefully, when to say I actually need to have somebody else do this. And of course we see with our own health, when we self-diagnose, a lot of times we get it wrong. And so we need to do the same thing with our businesses. We need the CPA, we need the business attorney, we need somebody who's in charge of sales, and we need that CFO.
I mean, I always say, and I think it's true, is that every company has three major functions. Mm-hmm. Every company. So, a lot of times we'll interview with a company and they'll say, have you ever done anything in in making soda pop? Mm-hmm. Which I have actually, but this is an example. Well, no, but every company has three major functions. Right. One is sales and marketing. Mm-hmm. So you're out there trying to get clients or customers, mm-hmm. and you're spending some money mm-hmm. to attract somebody to your brand. Mm-hmm. And then you get the order, then there's operations. So now you have to make a product or service, or deliver a service, or mm-hmm. make a product and give it to the customer. And it has to be done with efficiency and mm-hmm. quality and satisfaction to the customer. Mm-hmm. And then the third major part of your company is finance and accounting. That's where all the money comes together. Right. But most entrepreneurs don't think about a finance and accounting as something mm-hmm. important that they should be spending any money on. They want to spend as little as possible. Mm-hmm. And it's really tragic, because it's really where all the rubber meets the road. That's where the dollars and cents are. Right. And by spending as little as possible, you're go back to my airplane example, you're flying blind with no instrumentation, and you have all these people counting on you to provide money for them to pay their mortgages and have a nice life, and you're failing them because you're not paying attention to your data. Right. It's just tragic.
Mm-hmm. And I love that you talk about it needs to be forward thinking. We do need to know what we did in the past, because if you don't have any place to start. But if we're not thinking, okay, here's where I want to be a year from now, 5 years from now, 10 years from now, whatever the numbers are, it's kind of like your marketing goals. If you don't have goals, how do you know when you reach it? And same thing with financial. If you don't have that blueprint in place, it really, you don't know when you get there. More importantly, you might have detoured, you might have crashed. So it is so important to be thinking about, what do I want to be when I grow up? What do we want this business to be a year, 5 years, 10 years from now?
Well, the funny thing is most entrepreneurs are really good at that part. Mm-hmm. Jim, I want to have, I want to double my sales in mm-hmm. next year, or right. within the next 3.
But it doable?
But the part they don't have is the blueprint. They don't have the plan mm-hmm. for how they're going to go from where they are today to there. Mm-hmm. And we always start back to we start with a 3-year goal. What do we want to see 3 years from now if we're mm-hmm. working together with the company? And let's say they say we want to double. Well, then we say, okay, well, then year two, what does it look like? And year 1, what should we do? And then the next 90 days, what should mm-hmm. we do? So what we're doing is building accountability. We're building, well, is this really possible? Number mm-hmm. one, you may end up saying, well, maybe doubling is way too aggressive. We should mm-hmm. maybe think about 50% growth mm-hmm. or something. So it's all good stuff. Mm-hmm. But at the end of the day, we're going to have a 90-day plan. We have a marketing assistant, and she knows what we do and everything. And she came up with this concept recently, which was awesome. It said, you have no accountability in your business without strong accounting. So by having a plan that you say, here's what we're going to do over the next 90 days and define goals, mm-hmm. you're establishing accountability right. for the people in the company, the salesperson, mm-hmm. the operations person, mm-hmm. even the finance person, of mm-hmm. how we're going to run this business, and on a short-term basis in order to achieve the longer-term mm-hmm. goal. It's there's another thing I saw recently, where having a goal without a plan is a wish and a hope or something like that. Right. I think it's really true. I mean, mm-hmm. And every entrepreneur can tell you what their long-term goals are in terms of dollars and cents, mm-hmm. but not in terms of what the plan is to get there.
Right.
That's my opinion.
And of course, a lot of them have those goals. And, in the marketing world, a lot of times we call them BHAGs, big, hairy, audacious goals. And so they might say, I want to make $1 million or whatever, but they really have absolutely no idea if it's even possible, let alone how to get there. It just sounds good. I want to make $1 million, right? I want to, there's all these, and so they have their dreams, but they don't have that plan, like you said.
Right.
And I think we saw, oh, go ahead. Mm-hmm.
Well, the plan incorporates, saying a plan is a cool name, cool word, mm-hmm. but the plan incorporates, do you have the right people? Mm-hmm. Are they in the right roles? Do you have the right processes? Do you have the right products and services? Right. Where do you stand with the competition? Mm-hmm. The plan incorporates a lot of dynamics that mm-hmm. could affect your ability to achieve the goal that mm-hmm. need to be part of it, part of the plan. You know what I'm saying? Mm-hmm. It's important to look at all aspects of that. So, for example, if you wanted to double your sales, but your sales department is underperforming, mm-hmm. And you better start thinking about what you're going to do to improve mm-hmm. your, right. you maybe need to improve the processes of the sales mm-hmm. department, or you need to change out the people, or maybe need to do more advertising online, or there's got to be, if you're underperforming, you're not growing at a rate that gets you to where you want to get to, mm-hmm. then something's got to give. Mm-hmm. And so that's all part of the plan is looking at all the dynamics of what has to happen in order for the plan to be achieved mm-hmm. and identifying if there's any issues that need to be addressed. Mm-hmm. That's the, profitability roadmap or blueprint.
Right. And I think obviously COVID forced a lot of that to happen. There's no way we could have planned for that. Now, I am a firm believer that businesses should plan for a crisis. And it's funny, I used to do crisis management planning. So I'm like you, I'm biased. And so you should plan on, okay, what happens if the power goes off for a week, or, your chief salesperson keels over dead, or whatever. You should plan for those type of crises. Nobody plans for COVID. That's out of the realm of anybody's knowledge. But at the same point, I think it really did, obviously, it exposed a lot of things. I was talking with a person who owned a restaurant, and they've actually survived. They did well. They survived. They were able to go into delivery. They built a drive-through window, all sorts of things. But, they really sat down and took a hard look at everything. They had to, they came to the realization quickly that this is something that's going to be with us for a year. That was, 2 years ago. But one of the things that they looked at, and you see this a lot of times with kind of your supply, whatever you're doing, they looked at their menu, and they had this menu that had everything anybody could ever possibly want to order from them. And because their system was computerized, they were able to go back through and go, okay, what are the top 30 things that people order? That's what we're going to sell. These things that are nice to have on the menu, all of those. No, if people aren't going to order them, don't have them on the menu. More importantly, don't have the supplies to be making them. It's one thing if it's, cheese that you can put on anything, but, knowing all those things. And they said that really was one of the things they had a 20-page menu, and now they have a 2-page menu. And nobody's complained, nobody's fussed. And they said, yeah, can we still do some special order things? Yes, but there's a cost to it. And so, yeah, I think COVID really did make businesses, kind of whatever size they were, sit down and think, okay, we really need to rethink what's going on here.
100%. So, I can give you lots of examples, but one example, when you said all that, it takes me back to the Great Recession. Mm-hmm. in 2008. And so at that time I was doing what I do today, but a lot of my banker friends would say, Jim, can you do turnaround services? Can you go in and help companies that are in financial distress? And so I did a lot of projects like that, and I actually got certified as a turnaround professional, which is only like 200 mm-hmm. certified turnaround professionals in the US. Mm-hmm. But where I'm going with that is as part of that, I had to take a test and get trained in how to be a good turnaround person. And one thing they taught you is that the number one reason why companies get in trouble is weak management. Mm. So you think like, okay, well that's obvious, right? What is weak management? Weak management is not having any kind of planning. Mm-hmm. Yeah, weak management is, just going along to get along and not really running your business like a business. And when things like that happen, there's other things that happen because of I don't know if it's necessarily because of COVID, but another big thing that happened last year is supply chain. People couldn't get their products because they were coming across the water, and it was used to take 20 days, 26 days. Now it takes 96 days or 106 days. And you have to pay for the product when it leaves the manufacturing, but it's sitting on the water
and sitting somewhere.
And so when all those things happen, and business is not predictable. Mm-hmm. Business is not you come into every day and everything's always the same. You have to be ready to. You have to have a plan so that when something happens, that you can sit down and look at the plan and see how it is going to be affected. Right. And a good example of that is cash forecasting. So if you don't have a good cash forecast and all of a sudden that happens, you have to realize, how is that going to impact my cash? And maybe I need to borrow more money, get a bigger line of credit from the bank because I'm going to have to pay for all these products that I won't have to sell for months. It's extending out my supply chain time. But my point is that going back to the thing I learned is that, it's not because you were inefficient in your manufacturing or you didn't have a good product. It's because you are a weak manager that you get in trouble. And weak managers are people that just, don't do any planning and come in every day and think that things are just going to continue on the way they've been for years.
They have the hope and prayer. They hope that it's going to work, and they pray that it works out.
During that time, they were family-owned businesses that the world had changed on them, and they didn't change with it, and they got excuse my language, screwed and lost their business. And it was sad, but it was really their fault for not running their business properly.
Right. And how many businesses are hoping that next big deal is going to come through? You've been mentioning all along, this client, he's not going to be 95% of your business. You plan accordingly, but how many times do we see businesses that really do think that next big one, we're going to sign them? I learned long ago that, especially, for businesses like what I do, you have to be very careful about how big somebody is. If they're 50% of your business, maybe even, less than that, but if they're a good sized portion of your business and they go away, you're screwed. That's, and I saw that happen. I worked for an agency one time, and we had this great client, loved them. They had been with the agency for many, many years. And we didn't even negotiate the contract every year. It was just rolled forward. And then they got a new director of marketing who didn't like us, and we were out the door. It was, they gave 30 days notice. That was it. And, we were in serious trouble because that was a very large portion of their business. And they honestly never could make it up.
Well, they should have had a plan, because whenever a bank looks at giving you a loan, they look to see what they call customer concentration. Right. And if you have one big customer like that, you better have a plan how you're going to survive if you lose that customer, which most people don't. Right. My first client when I moved here,
we're buddies.
Michigan,
we're whatever. Yeah.
Yeah. Oh yeah. So let me tell you this story. My first client when I moved here from Michigan was during the recession, and it was a company that managed the collectible department at Walmart across the country. So baseball cards, trading cards, all kinds of collectibles. And they lost the contract with Walmart, which was 88% of their sales. Oh! And so the bank called me up and this company's in big trouble. They just lost their biggest customer, and this is probably going to be a liquidation. So I went out and I met with the client, and I said, hey guys, what are we going to do? And they said, well, you know what, Jim? To be honest with you, we used to make money off of Walmart, but they're so chintzy over the time. I don't think we were making any money on Walmart anyway. So maybe we can create a company out of the 12% of customers that are left, it actually is profitable.
Interesting.
My point is that they should probably already have known that.
Right.
But,
Yeah,
we
they
ended
should
up
have been.
creating
I mean, why are you
plan.
spending all that time even doing that?
Yeah, because they didn't have me or somebody like me helping them, think through all the different things that could happen. They were they didn't really know. They didn't even know if they were making money on Walmart, which they should know. They didn't know that. So, we did a plan and we put it forward to the bank, and they allowed us to continue operating, and it's still in business today. The company's still around. So
very
yeah,
cool.
It was pretty cool.
But
they lost 88% of their sales. Think of that. That's a huge thing.
Yeah, that's incredible. But yeah, if it wasn't doing what it needed to be doing, then I mean, for one thing, it needed to be gone. That's the thing. I always tell people, there are clients that it doesn't matter. You just don't want to work with them. Things have gotten, maybe they never were good. All those various things. And so why still be working with them? And that's where it's painful to think, okay, they bring in 80% of our business. I can get over not liking them, but really, that's something to be looking at.
The current example of that is Amazon. So Amazon, everybody sells through Amazon because they're the big kahuna, right?
Yep.
But most people don't really understand how much money they make off of Amazon because there's so many deductions and chargebacks, and they send you these cryptic memos, and they take money. You think you're going to get $100, and they send you a check for 80.
Right.
And then they send you these cryptic reports, so you have no idea what they're doing. But you don't have time to go and analyze that because you're too busy, selling
you're still
more
fulfilling. You're doing, it's kind of like when we got
you're making money, but you have no idea what they're doing, or how much money you're actually making from Amazon.
And you don't know if you can make adjustments. I mean, all of those things. It's like, way back when we got our very first paycheck. Remember, we get this very first paycheck, and we're thinking, I made $1,000. But wait a minute, this is taken out, and this is taken out, and this is taken out. And all of a sudden, you've got $750. If you were lucky, out of that 1,000.
Today, when I get my paycheck.
Yeah, all those deductions.
I have that today.
And I think businesses.
I only get why.
Yeah, it's and we forget, like we've been saying, that all of those other things play into it. It's not just that you have A, you sell it for B, you've got C. No, there's a whole nother alphabet that's really under the layers there.
Yeah, and you better be taking that. You better have that data in front of you when you price out how much you're going to sell your product for.
Right.
And most people don't, by the way. Most people just
well, and that is when I talk,
guess it by golly. But.
One of the things that we talk to people about is how to price their product. And of course the one of the first things that so many people say is, well, my competitor prices it at this. I haven't done it quite as long, so I can't charge as much. And so I'm going to charge, and they have no idea how they got those numbers. It was just, they plucked them out of thin air.
Right. We have a client, they manufacture products that are used by the Navy. And the Navy came in and did an audit of how much they were charging for the products. And we found out that a lot of the products we were selling at less than our cost. To make it. So the result of the audit was we were able to charge more money to the Navy. But we should have known that, we should have known that we should have had better cost accounting to know that, these products, we need to up the price because we were losing on all these products. They were, again, looking at the bigger picture. Hey, we're making money, we make money every month, no big deal, and not getting into the details, which is super important.
Right. Well, one of the things that your company does is a profitability roadmap. Tell us what that is and kind of walk us through that. But don't give everything away because we want people to actually call you. But tell us what a profitability roadmap is.
Well, I mean, we've touched on it in our discussion already, but I'm going to say something. I'm going to paraphrase something. I don't think this is the exact quote, but I always quote Henry Ford. Once said, a business of a business is making a profit. So the business of a business isn't making diapers or selling cars, or it's to make money.
Yeah, because you have to be able to continue doing it.
Yeah, and if you don't make money, at some point you're going to go out of business because you can't survive if you're not profitable. But most companies, when they think of doing their planning, they don't start with profit. And we have a client as an example. They're a software as a service company. They provide a service over the internet for companies to manage their employee database. And they do before we got involved, they would do their planning every year, and they would pick a number, but at the end of the day, when they got to the end of the year, they never made their number. And the reason was because they were spending money without keeping track of what their budget was. So they were spending money, but beyond that, they didn't take profit, make the profit the most important part of the budget. To say, we want to make $1 million this year. And as we go down the road, things are going to change every month. We have to be looking at that. But that's the thing that's not going to change. We're not going to give up profit. If we get to the halfway through the year and we've only made 400,000, then we got to figure out how we're going to make 600,000, which means we may have to cut costs, or we may have to sell more of this or some more of that and make more margin. But at the end of the day, the only thing that is non-negotiable is that we're going to make that $1 million. There's a book called Profit First. It has that same concept. Most business owners, especially for small business owners, they're not really managing profit. They're just managing what comes in and what goes out, and not thinking about the Profit First book gives you kind of a maybe a hard example to follow, but what they say is every dollar you collect, you put 20 cents away in a savings account because you can't spend that. But it's kind of the same idea. By having a profitability roadmap, we're taking our client, we're actually justifying our existence because we're taking the client from making 700,000 to making $1.2 million, because now we've created a plan that was way over and above what their plan was to get to that incremental profit. Right. It's what we call the profitability roadmap.
Well, and as you were talking about, I thought, one of the most basic things is kind of the most basic initial statement. If somebody says, hey, Jim, I want to make $1 million. Okay, that's great. But is that $1 million profit? Or is that $1 million and then you got a 1.2 million in expenses that has to come out? And I think that's where people miss out. They just say, hey, I want to make $1 million. And they forget that there's that other piece in between.
Yeah, what people typically say, and I'm working with hundreds of companies again, they say the sales number, we want to do 10 million in 2022 or 20 million in 2023 or whatever it is, but they don't say we want to make $1 million in 2022 but it should start there and go backwards. But they always start at the top, and then whatever costs sift out at the end to make. As long as we made a profit, we're happy.
Right.
I have a client right now. They're a professional service organization, and they showed me their budget for next year. This year they made 500,000, and they're going to make sales are going to go up like 3 million, and their bottom line's only going to go up 100,000. I'm like, oh, that's not a good plan.
No, that doesn't sound quite right.
He goes, well, because we're doing this and we're doing that, and like, well, that's not good. We're not doing that. We have to make more money than that if we're taking on this risk to hire all these people and lease more office space and get all these computers for people and all this other stuff. Then we have to be accountable to having it'd be like if you're a publicly traded company, you're accountable to your shareholders to deliver a proper return on their investment. But it should be the same thing for a private company. If you're going to invest money in something, it should show up on the bottom line somehow.
Yeah, it's funny. I always have a discussion when I'm talking with nonprofits. I tell them nonprofit doesn't mean no profit. They still have to make money, or they can't do what it is that they want to do. Years ago, I actually started my career in public relations at the American Cancer Society. Fabulous organization, especially to learn how to be doing what I wanted to do. And at that point, they were in the top 5 probably of nonprofits in the world. They were gigantic. And I mean, and there were millions of dollars that went through them. But there were also, a lot of expenses that came back out. But it was always interesting when people would go, well, now wait a minute, and we always told people, if you're, I was a communications person there, and so one of my goals was to show, okay, if you donate $1, here's what actually comes out of that. And, and because, the dollar was not going towards a cancer patient. It was, there were the expenses that came out, all those various things. And so you didn't want to come out in the hole, obviously, but you still wanted to have some money going to the cancer services, but you needed to understand there were a lot of other things that were in there. But yeah, no profit doesn't mean, non-profit doesn't mean no profit. They got to have money. We all have to have money. Doesn't matter what we do. We have bills we have to pay too, right?
I mean, they're managing to a bottom line of zero, kind of, but like you said, but if they actually really did that, then they probably would run out of money at some point. So you always have to be erring on the side of caution with respect to making sure that you have money to run the company.
Right. And there, I think that's one of the other things that people lose track of is what are their future expenses. I talked to several people who got themselves in binds because they took the loans that were offered, over COVID, and then I have to pay it back. What do you mean I have to pay it back? But then I had another friend who, now she is probably one of the most absolute practical people in the world, and she got one of the loans, but she put it in a totally separate bank account. I mean, it really was, if we absolutely positively have to have it, we will use it. Time came, they wrote the check, they paid it back off. And they never had to dip into it, but it was kind of that little, mad money fund. But yeah, she knew, it was not monopoly money. I think that's what a lot of people are, oh, look, it's free money. Oh.
Yep, there's no such thing as free money.
I know, or free lunch. It's been long ago.
Lunch, right?
I had a political science professor, and she was a little different, let's just say. And she would come in, and she had this long flowing cape, and she'd come busting into the class, and she would say, "Tom Stoffel," and we'd look at her, and she would say, "There's no such thing as a free lunch." And she was right. There really isn't. There's somewhere there's a price to pay, a hitch, a catch, something. But yeah, there's never a free lunch. I tell people that on Facebook when they're posting that, hey, if I post this, I can win $1 million. No, there's something in there they wanted.
Right. Well, yeah, there's always a catch.
Yeah. Even if it's just that they want your mailing address, your email address, so they can send you things. I mean, yeah, there's a catch to everything. And that's not being cynical. That's being rational. It goes back to, when we were little bitty kids, I might give you my sandwich, but I'm wanting another sandwich in return. So.
Right. Exactly.
Well, Jim, we've only got about 5 minutes left. And so I want to know more about what Blueprint CFO does specifically for their clients.
So good question. The first step we do is what we call the discovery assessment, where we come in and analyze how the company is performing.
Okay.
And we do a three-year look back. So that gives us an idea of how, if it's growing, if it's not growing, if profitability is increasing or decreasing, if their costs are, skyrocketing and they're not managing their costs. So what we do is kind of create a benchmark for the future in terms of how the company is currently doing. The other thing we do is we assess the accounting department. So there's maybe things that are being done in the accounting department that can be automated and made more efficient. A very good example of one is we have clients that like to print out checks and paper checks. You were mentioning checks before. Most payments today are made in an automated way through an ACH process. And if you're not doing that, you're doing a paper check and putting it on somebody's desk, and they're signing it, and you got
and it might get lost.
Put a stamp on it and take it to the post office. Remember the old days when you went to the grocery store and everybody wrote a check for their
I
for
know.
their
I think I write 2
groceries.
checks a year now.
Today when people you do that, you're just like, you're slowing down the line. What are you doing?
Oh,
You
yeah.
know,
And they're like
I'm in
90,
a hurry.
right? You know,
Credit card in there,
Mhm.
lady. You know, but or even paying cash. But anyway, so there's things that we come up with to help reduce the accounting expenses because we're accounting experts.
Right.
So that's kind of a cool side note of what we do.
Mhm.
So when we present this plan, after it's usually a 30-day period, we go through the discovery assessment, and we present a report to the company in terms of how we see things and where we see there's opportunities to improve the business. And some of that comes through interviews with the management team, where they will tell us, you know, hey, we think we could be doing better at this part of the business or that part of the business. So that is good input for us to help create the plan of the future, because if there are issues that need to be resolved, or you know, problems that are emerging that aren't being addressed, then that has to be put into the plan. And that's the next step. So the next 30 days is creating the plan, and then after that, every month we prepare the monthly financial statements. We make sure they're right. Because the first thing that happens if they're not right is when you get in a meeting and say, hey, here's how the numbers came out for November, and people say, well, that's not right. Because you know, this or that's,
we still have money in the bank.
Stopper. So it has to be, you know, a good example is sales. You know, the salesman will say, I sold $1 million last month. Well, okay, you sold some of that actually was in the month before, and some of it was in the month after.
Of it's
so the
promised.
actual real sale. Yeah, it's not really. Yeah, you haven't got the signed deal yet, but you've sold $1 million, right? So you know, everybody agreeing that the numbers we present are the numbers, and that you know, there's no discussion is a good starting point. And then we meet every month with the client to go through their numbers, and we create a custom report that has a lot of charts and graphs and identifies their key performance indicators. So it goes way at the very back of the book. There's maybe 15 pages of this report. It's customized for each client. And in the back is the balance sheet and income statement, which we used to get, which has now become obsolete because nobody wants to look at all those numbers. You know, because now they've got this year versus last year, this year versus year to date this year versus year to date last year, this year versus budget, year to date this year versus budget. So it's all really good. I mean, we spend at least an hour with every client walking them through the book. And it's interesting to me because they're just fascinated by it because they've never seen this data like this before. And they people that don't even like accounting, they love talking about all these different things that we're presenting. It's been a mind blower for me in terms of getting people engaged with managing their business better and you know, paying attention to their numbers. So after we had that meeting, out of that comes a bunch of notes that we make about, you know, here's why we didn't achieve our budget in this month, and so here's the things that we're going to do to improve the future, and that gets baked into the forecast, so that next time we come back, we have a revised forecast. So the forecast is not static; it's what do you call that? You know, iterative as we go through the year. Yeah, because of things happen like COVID, right? You know. We have a client right now. They have 10 people that got sick on COVID 2 weeks ago. So how does that affect, you know, and it's a manufacturing company. So how does that affect whether they're able to achieve their goals or not?
Right.
So.
And then it spirals. I mean, you know, that's the thing a lot of people don't get is, okay, well, you know, we were supposed to produce 100 widgets. We only produced 50. What does that do?
Right, exactly. So, you know, that's what we call it future-based accounting, because basically we want to learn from the past and apply those lessons to the future. But most accounting departments stop with the documenting what happened in the past and don't think about the future. And that's really where the cool part is thinking about how you can make everything better.
Right.
You know,
how you can make that $1 million.
Yeah. Without doing that, you're at the whim of the market, basically, right? So you're not controlling your own destiny. Let's just say that.
Now, can you do this virtually with folks, or do you need to meet with them in person?
So pre-COVID, we met in person. Many of my clients, I would go once a week to their office and be there on Thursday afternoon or Tuesday morning. When COVID hit, everybody said, "Well, you know, we can't have you come to the office," which kind of was a an eye-opener for us because we found out we could be way more efficient working remotely.
Oh, just the commute time that you saved probably was incredible.
Especially in California, the commute is horrible. So we were able to be much more efficient, deliver a lot more value to the client, and we would have, just like we're having a Zoom meeting where it's just like you're sitting across the table from each other and present data, and everything was great. So who knows what's going to happen in the future? Will we go back to meeting face to face? I suppose a bit.
Yeah, a combination probably.
Everybody. Yeah, I think everybody recognizes that this is a good way to do things too.
Right. I love it. Well, again, your company name is Blueprint CFO, and so it's at blueprintcfo.com. How do people reach you?
So you can call. There's an 800 number on our website, or you can email me at Jim at blueprintcfo.com, and I'd love to chat with anybody about their business and what challenges they're facing, and see if there's something that we can do to get them the data they need to solve those issues and move forward and make more money. So
easy. I love it.
We love talking. Every time I get a new client, it's fun because we get to learn, a whole new thing, and it's just fascinating. I was a CFO for a company for 15 years after I became after I left CPA, and what I found was every day I was going to the same place doing the same thing. And, I really love the variety in my job of thinking about different businesses and, how the dynamics of that industry are different than the dynamics of another industry and, how that plays out with respect to the future.
Yeah, that's why I like agency work. Same thing. Well, Jim, this has been absolutely fascinating. Do you have any final thoughts that you want to leave everyone with?
Pay attention to your data. Don't run your business like that airplane pilot with no instrumentation. Make sure that your accounting department is getting you the data you need to make good decisions, and don't settle for less because great accounting pays for itself.
I love it. I love it. Well, I've been having a wonderful discussion with Jim Downs of Blueprint CFO. I'm Deb Creer, and until next time, everyone have a great day.
Tune in for our next program for even more trends, best practices, and techniques for how to make your business a success. The Business Power Hour, hosted by Deb Creer, is proud to be part of the C-Suite Network.